the best performing stocks in the last 12 months was actually SMCI, Super Microcomputer. That's up 766% in the last 1 year, making NVIDIA, Meta, and PLTR look like losers. And so many people have been asking me about this stock recently, including your granny. So I decided to take a closer look at it and do a valuation, and I found it's actually still cheap. In the last 12 months, I was so focused on my own stocks like Meta, like Palantir, like ASML, NVIDIA, and Salesforce that have gone up a few 100%. I was like really happy with it, doing really well for my portfolio, that I completely missed out SMCI, which if you take a look at the last 12 months, it makes NVIDIA, Meta, and Palantir look like fixed deposits. So initially, when I looked at SMCI on the charts, it was like going up like crazy. I thought, okay, it must be way overpriced, it's overextended. So I kind of like ignored it. But then in the last couple of days, I took a closer look at it and said, okay, this is something interesting. And when I did more and more research, I found that actually SMCI is not expensive. In fact, it is still cheap at today's price. So let's understand what the company does. So Super Microcomputer, they focus on selling AI server solutions. Servers and storage solutions. For example, they sell these rack mounts that are used to deploy AI chips. Now, unless you've been living in a rock, you know that we're going through an AI revolution. And this is not just a hype. AI is literally changing our lives and will continue to transform the economy and businesses in the next 5, 10, 15 years. I talked a lot about this in my webinar last year on the 6th Innovation Wave event. In fact, if you just take a look at the recent product launched by OpenAI called Sora, you can see, my God, it's going to put many designers and production houses out of work. So you find that in today's world, almost every business has to use AI or risk becoming obsolete. Now, in order to run all these AI solutions, you need a tremendous amount of computing power. You need all these chips, right? These graphic processing unit chips that's made primarily by NVIDIA. And that's why NVIDIA's stock price has gone up like crazy, because of this tremendous demand for these GPU chips. And of course, AMD is the second place. But when you buy all these NVIDIA chips, you can't just leave them on the floor. You have to deploy them. So how do you deploy these chips? Well, you need servers. You need these rack mounts to deploy these AI server chips. So this company, SMCI, they build customized and modular server solutions that are used for mounting these AI chips that are made from NVIDIA, AMD, and Intel. So if you take a closer look, for example, you can see this is one of their server racks. And within these server racks, you put in your NVIDIA chips, your AMD chips, and your Intel chips. So think of these AI chips like ice cream. And the most popular ice cream right now is NVIDIA's ice cream. They are the Haagen-Dazs of the chip world, right? But in order to eat the ice cream, you need an ice cream cone. So if you think about it that way, Super Microcomputer makes the cone where you put your ice cream. So the more that people need ice cream, the more SMCI needs to sell their ice cream cones for people to place their ice cream on. And right now there's an insatiable demand for ice cream because everyone wants ice cream, okay? Now, so let's take a close look at this company. And if you look at the financials, it looks pretty decent. Look at the revenue. The revenue has been growing very consistently, especially accelerating in the last 2 years because of, again, this AI revolution. And the net profit, the net income has been increasing consistently for the last 5 years. So it does meet my investment criteria. And that's why I'm kind of like kicking myself for missing this out. You know, there are many companies which I miss out, where the stock price flies and I didn't buy, right? But for those companies, I don't really care about it because they never met my investment criteria. So if a company doesn't meet my criteria and goes up, it's like, who the hell cares? It's not my game. But when a company meets my criteria and it goes up, I'm like kind of like slapping myself like, why didn't I see that? Okay. But it's okay. It's never too late because investing is not a sprint, it's a marathon. And sometimes if you're late to get into a business in the early stages, there are still many innings to play as long as you buy when it's still undervalued and it's still a growing company. So anyway, having said that, So revenue is growing, net profit is growing, but their cash flow is only starting to get positive. So they had very inconsistent cash flow in the last couple of years. That's probably why I missed it out in my scanner. But in the last 1 year, you can see their free cash flow beginning to accelerate as they reach scale. Now, the company has also a pretty strong balance sheet that makes me comfortable. They've got an interest coverage ratio of 58 times. They've got a debt to EBITDA ratio of 0.42 times, or 0.42, which is very, very low, very, very strong balance sheet. And they've got a return on equity of 33% and return on invested capital of 31%. So all their profitability and all their debt ratios look pretty strong. So it seems like a pretty good business that's profitable, but again, a good business can be a bad investment if you pay too high a price for the shares. But a good business becomes a good investment if you can buy it for less than what the shares are worth. So what are the shares worth? What's the intrinsic value? So I kind of plugged in the numbers, and I'm using a discounted net income valuation model because their net income is a lot more consistent at this stage than their free cash flow. So I put in the numbers. They are making 732 million in net profit in the last 12 months. They've got 375 million in debt. They've got 725 million in cash and equivalents. For the growth rate, I looked at 3 different websites, right? Finviz, Capital IQ, as well as Capital IQ, what is the lowest estimate? So I took an average. That gave me a 37% growth rate in the next 5 years, which kind of like syncs with a lot of analysts' projections I've been looking at from various sources as well. And I'm going to assume that the growth rate will then drop over the years. They've got $55 million, 55 million shares outstanding. So when I put in all these numbers, it gives me an intrinsic value of $1,005. So at the current share price, after it dropped on Friday, it dropped like 20% on Friday because of probably profit taking, it closed at $800. So currently it is 20% undervalued. A business may seem very profitable now. It may look undervalued now, but to me, the most important thing is to look at the competition. Could their competition take away their market share? Could the competition take away the customers? And is their profit and growth sustainable? So in order to answer that question, I look at something called the economic moat of the business, or we call it the sustainable competitive advantage. So I'm only comfortable in investing in companies that have got a sustainable moat that can protect it from competition. Because if it doesn't have a strong moat, even though it makes a lot of money right now, it may seem cheap, but it may not be sustainable. They may be disrupted by a lot of competition that take away their market share, and eventually the valuation drops by half. So who is Super Microcomputer's major competitors? So we said that SMCI makes this ice cream cone. Why can't other companies make the same ice cream cone and take away their business? Okay, so their 2 main competitors are Dell, ticker symbol DELL, as well as Hewlett-Packard Enterprise, ticker symbol HPE. Now, in the last 1 year, SMCI returned 766%, whereas Dell only went up 97% and HPE declined 9%. So what's up with these competitors? Are they a threat? So what's interesting is that when I kind of like look closer into it, I found that, okay, so Dell and HPE, they also provide server and storage solutions. So if so, they provide the same ice cream cone, why aren't they able to perform as well as super microcomputer's? The reason is because Dell and HPE, they offer a very wide variety of IT products, and they are not specialized into the server and storage solutions that's required for this high performance computing, or HPC, and AI solutions. So in other words, they make ice cream cones, but their ice cream cone doesn't fit the NVDA ice cream as well as SMCI. SMCI's ice cream cone fits NVIDIA and AMD's ice cream cone the best, to give a very simple analogy, right? So again, SMCI primarily focuses on servers and related server hardware, whereas Dell and HP are very generalized. They do a lot of things, they are not specialized. And SMCI tends to prioritize high density, performance driven solutions that are optimized for AI, whereas Dell and HPE cater to a broader range of needs and price points that are not specialized. That's the reason why SMCI has been gaining tremendous market share in their partnership with NVIDIA, AMD, and Intel. Now, in terms of economic moat, Dell and HPE has no economic moat. So they don't really have a competitive advantage. And that's why these are two companies I would never touch no matter how cheap they are. So you can see in terms of valuation, on the surface, SMCI has a forward PE ratio of 27 times. Now Dell is selling at 11 times, HPE selling at 7 times. So some people who may be value investors will say SMCI looks more expensive, 27 times earnings, whereas Dell and HPE is very, very cheap. But one of the things that I've learned as an investor is that, things are cheap sometimes for a reason. Cheap crap is still crap. So I rather pay a premium or a fair price for an excellent company rather than a cheap price for a lousy company. Okay, so to me, quality is always more important than price, but it must be selling at an undervalued price for me to buy in the first place. Okay, so SMCI has the highest forward PE, but SMCI is projected to grow at 48% in the next 5 years. So it's a high growth company, whereas Dell is only projected to grow at 10% and HPE only projected to grow at 2%. So this is kind of like the Lamborghini, the Ferrari, and these two are kind of like the broken down old Honda Civics, if you will, okay? SMCI, I mentioned their intrinsic value is $1,000. So right now at $800, they are 20% discount. So even though Dell and HPE look cheap on a PE basis, on a price to sales basis, but if you calculate the intrinsic value based on their discounted cash flow and their income, you can see Dell is only 3% undervalued and HPE is only 7% undervalued. So SMCI, I wouldn't say that it's a very, very strong company, because to me, a strong company must have a wide moat that's indestructible, like Microsoft and NVIDIA and Google. SMCI to me has a narrow economic moat, which means they have a moat, but could they be disrupted in the future if Dell and HPE invest a lot in R&D to also develop the same high performance solutions? The answer is maybe. Not right away, but in the future. Okay, but SMCI does have a narrow economic moat that comes from their intellectual property in designing denser server configurations for high performance computing, catering to AI and cloud needs. But the problem is that they sell servers, they assemble all these servers, and many of the components of these servers are commodity components, which means that other companies like Dell and HPE, they could also assemble the same kind of servers given enough research and time. So it may make it challenging to maintain significant price premiums in the long-term future. So because of that, for a stock like SMCI, would I invest in it? Yes, I would, but I won't invest too much. To me, it's got a narrow moat. I would invest less as compared to a wide moat company like Microsoft or Meta or NVIDIA or Amazon. Next, how does SMCI compare to other high quality AI stocks that I'm invested in as well? Because before I buy shares of a new company, I like to always compare it with my companies and ask this question: is it as good? Is it cheaper? If it is, I don't mind building a position. But if it's not as good or it's not as valued, then why even bother, right? Okay, so over here I'm comparing it to some of the AI related companies. Now I don't own all of them. I don't own AMD, I don't own Tesla, but I own the rest of them. And of course, this list is not exhaustive. I didn't include ASML, Salesforce, I didn't include Adobe. Okay, so I mean, I could have a whole long list, but I didn't include everything. Now, of course, if you want everything, do join my Ultimate Investors Playbook, where I do a deep dive research into all these stocks. So this is just a brief overview. So comparing to these companies, in terms of price to sales ratio, now there are many ways to value a company, as you guys know. So a very simplistic method is to look at price to sales ratio. In terms of price to sales, SMCI is the second cheapest next to Amazon. In terms of forward PE ratio, which means the PE ratio based on next year's projected earnings, SMCI is selling at a forward PE of 27 times, which is not the cheapest, but it's cheaper than NVIDIA, it's cheaper than Tesla, it's cheaper than AMD, it's cheaper than Microsoft, it's cheaper than Amazon and Palantir. Okay, now if we do an intrinsic value calculation based on discounted cash flow, discounted net income, you can see my valuation over here. Now, based on that, SMCI is actually the cheapest of all these AI stocks. It's selling at a 20% discount to valuation. The next cheapest is Google, selling at 19% discount, Palantir 15% discount, Amazon 7% discount, Meta 1% discount. By the way, having said that, for Meta, I'm using a very conservative growth projection, all right? But still 1% discount. Whereas all these are a bit overpriced right now. Microsoft is selling at a 3% premium, so more or less at fair price. So finally, let's take a look at the charts. Now, before I buy a stock, I don't just look at the fundamentals, the intrinsic value, I look at the technical analysis as well. I look at the charts. So ideally, I don't like to buy a stock when it's kind of like flying away, when it's like waving up, because it tends to, after wave up, it tends to wave down. I like to buy after a wave down to a level of support. Or I like to buy when it first breaks out of a long consolidation. So SMCI actually has been consolidating for quite a number of months, and it actually did a breakout over here, and it retested this previous resistance, and that it flew away. Okay, so like again, I'm saying I'm kicking myself for not looking at that or not discovering that earlier. But you know, that's life. You can't catch everything, right? Now, so since it broke out, you can see it's gone up like crazy. It's gone up like almost parabolic, almost at a 90-degree angle. And then on Friday, we had this huge mother of all bearish engulfing candles. That's called a bearish engulfing candle. So usually a bearish engulfing candle is a bearish reversal pattern that may, I mean, no guarantees here, but may see the price, you know, fall a bit more down in the next couple of days. But again, you never know, all right? Sometimes after a bearish engulfing candle, it could reverse back up as well. You never know. Like I said, I'm interested to buy this stock, but of course the challenge is, how do you know where's the bottom of a retracement? I mean, what if you buy here and it goes all the way back down here, right? Or what if you don't buy here, you're waiting for it to go down here and then it reverses back up? That's always a dilemma for an investor. And that's why one of the things that I learned is that when I invest, I never buy at one go, because you never know, it could still go lower. I like to buy in tranches. So if I want to buy 100 shares of this stock, for example, I'll buy 25 shares first. And then if it continues retracing lower to a lower level of support, because you never know where's the bottom all the time, right? Then I'll buy another 25 shares. So I like to average in my position. So here's my rough strategy right now. Now, if you use a Fibonacci retracement tool, you can see that if you take this as the A to B wave, right now it has in one day retraced to the 38.2% support level. So this is one possible level of support over here. Now it could also retrace to the 50% level, which is about $700, and retrace to the 61.8% Fibonacci level, which is about $622. So what I may do, again, I'm not confirming this, but when the market opens on Tuesday, right, Monday the market's closed. When the market opens on Tuesday, I may buy a bit of shares, not too much, just a starting position at this level, right? Because I'm already buying it at a 20% discount, so I don't mind taking a starter position, but not too much. I will only buy more if it retraces down to the $700 to $600 level, because then I'm getting a 50 to 60% retracement of this wave up pattern, which would be more comfortable to build a bigger position. All right. Now, could it also retrace to the $543 level? Yep, at the 40 EMA on daily candles. Okay. Now, usually I like to buy at the 50 moving average, but given that their revenue and profits are growing so significantly, I doubt it's going to retrace all the way back to the 50 moving average. More likely, it's going to retrace, it's going to consolidate, and then the 50 moving average is going to catch up with the stock in the next couple of weeks. Likely that's going to happen. Okay. Now, one of the other things that I'm also going to consider doing is to sell a cash secured put option. So for those of you who understand options, I'm thinking of selling a put option, a cash secured put option at about $600 strike price over here. Okay. Now, when I sell a put option, what happens? I collect premium. I get money, right? So how much do I get? If I look at my option chain, and for example, if I look at the 600 put option, 600 strike put option over here, it's currently selling at a market price of $22.85. So what does it mean? If I sell a put option at the 600 strike price, I collect a premium of $22.85 per share. One contract of options is 100 shares, so I will pocket upfront $2,285 in cash by selling the put. Now, after I sell the put at $600, if the stock doesn't drop below $600, right? The stock goes up, it goes sideways, it goes down a bit, but it doesn't drop below 600. Now, it can even drop below 600, but by the expiration of the options, it stays above 600. What happens? Then the put I sold will become worthless. And I just keep the premium which I collected, which is $2,200, which is great. I get free money, right? But if the stock drops below $600 and stays there by the expiration of the options, then I'm obligated to buy 100 shares of this stock, which I don't mind buying because it's a good company. And if I buy 100 shares of the stock, I'm buying the stock at a strike price of $600. But recall, I'm also collecting $22.85 upfront. So $600 strike price minus $22.85. My actual purchase cost would be $577, which means I'll end up buying 100 shares of the stock at $577, which would be somewhere around here, which I think buying 100 shares here, which is a small position in my portfolio, I think is a good deal because I'll be buying it at almost 50% discount to valuation. So these are all the strategies that I'm thinking of doing. When it comes to Tuesday, then I'll execute depending on what transpires at the time. Of course, if you want to find out how I invest and trade every day, you can subscribe to the Ultimate Investors Playbook at insight.piranhaprofits.com, where I show my students, my subscribers every day how I am managing my portfolio, how I'm investing, how I'm trading the markets. But I hope this has been an eye-opener of my thought process of how I look at companies and how I make my investment and trading decisions. Thank you for watching, and I'll see you guys in the next video. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.